Yes, good afternoon, everybody. Thank you very much for joining us at the Carnegie Endowment today. This is probably the umpteenth, I can't remember, the fourth or so event we have had on the Euro crisis since the beginning of last year. And it's fair to say that the titles of our events have become more and more alarmist as we've gone on. And, so the title this time is, Will the Euro Survive? I think our initial title was something like the Euro Crisis, What Does It Mean? Or something like that. And so I'm hoping that there's not going to be a linear extrapolation of titles, that at some point this thing stops getting worse.
Well, at some point you'll drop the euro.
Which sets the tone for the discussion. Let me introduce our expert panel today, just very briefly, because you do have their vitae. To my left, Antonio de Lesser is the Minister for Economic and Financial Affairs and principal advisor to the head of the delegation of the European Commission in Washington, D.C.
Union.
Sorry?
I'm sorry.
Of the European Union. I'm sorry. Of the European Union. And that is also symptomatic because you will hear from Antonio the European Union view. And then next to me is Jacob Kierkegaard, who is a research fellow at the Peterson Institute for International Economics. And then to my right is Liliana Rojas-Suarez, who is a senior fellow at the Center for Global Development with expertise on Latin America and on financial services. And she was previously managing director at Deutsche Bank. And to the far right, geographically only, is Desmond Lachman, who is known to you, I'm sure, as a senior, is a resident fellow at the American Enterprise Institute and teaches at Georgetown University. And he has been a regular fixture at my Euro events over the last year and a half. So we're going to have a conversation, and the panel has kindly agreed to that, which makes it a little more difficult on them, but I think it's better for the audience rather than have PowerPoints and prepared remarks. So I'm going to start with one question that I'm going to ask all the panelists to address. And the first question is, will the euro survive in its current form? What is your subjective probability? And let me start with Desmond to the right.
Yeah, well, if you mean by that our country's going to drop out of the euro, then I would say that it's almost certain that countries will drop out of the euro. You know, that we've got a situation in Greece where it looks like Greece can't avoid a hard default. If you look at the numbers, Greece's debt to GDP, according to the IMF projections, is going to peak at 172%. The IMF has been notoriously inaccurate, overly optimistic in its projections, so it's more likely that it'll go towards 190, 200. So you know that the market has got it right when they're pricing Greek bonds at something like 40 cents on the dollar, meaning that the market thinks that Greece is going to have a something like a 60% haircut. Minimally it's more likely to be something like 70 cents. You've then got to think through if a country does have a haircut of that sort, and if its banks are holding a huge number of the bonds, it means that the Greek banking system is going to be in deep trouble. They're going to introduce capital controls. So it's not a very far step from there for Greece to be leaving the euro. I think that it really goes to the heart of the problem in Europe is that what we've got countries in a system where they don't have their own currency, but they've run up huge imbalances, both in the public finances and in the external side. And I think that what we're seeing is you can't correct those imbalances without writing down the debt and without getting out of the currency unit, without having the deepest of recessions. And a country like Greece doesn't really have the social appetite to do it. So I would say that once Greece leaves, you'll get real contagion to Portugal and Ireland, that those countries will leave in short order. So, if you're talking about, if you're just giving me a year or two, I would say that I would be prepared to give you odds on that event occurring.
Good. I mean, bad. Thank you. Desmond.
I don't think that it's bad from Greece's point of view. It's bad from Germany and France's point of view. But what the IMF is offering Greece is they're offering Greece not only a Great Depression, but they're asking them no prospect of getting out of that for the next decade if they stick within the system. So, this is not going to be too good for the German and French banks, and might not be good for Italy and Spain, but I would say that it would be good for Greece and Portugal to be taking the route that Argentina did in 2001, where, with all the stories as the sky would fall if they got out of the convertibility plan, they had a very nice decade. Thank you very much.
Okay. Thank you, Desmond. So briefly, apologies, but I have 13 questions. So, Liliana, will the euro survive in its current form, subjective probability?
Yes, I think I agree a lot with what Desmond said for practically the same reasons, and I want to add one more, and is that in a situation that we have right now, a permanent solution needs a transfer from creditors to debtors. We are going to get more into this with your next questions. So you're going to get a limit on the patience to which, and the limit to which that transfer from creditor to debtors can be extended. When that patience, I'm calling patience to a very complex issue, when you get to that limit of that patience, then I believe that support for Greece is going to vanish. I really don't think that is a question as to whether Greece and the European Union wants Greece to continue within the Eurozone. What I believe is that it's a matter of fact that Greece will not be able to continue in the Eurozone, that it will default, and that I agree with Desmond, that I don't think whether it's good for Greece, really. It's just that sometimes there are things in life that we don't choose. They have to happen, and I think that's an event that will materialize. My subjective probability of having Greece with that, Greek leaving the Eurozone is about 90% right now. If you add Portugal to that, it's 70%.
Thank you very much, Liliana. Jacob.
Well, starting with my subjective probability that the euro will continue with at least as many members that it has now, 100%. Because I regard it, we need to make a very fundamental distinction between whether a country defaults or deeply restructures or whatever we call whatever Greece is going to do, and leave the Eurozone. These two things are fundamentally different. I believe that Greek debt will be, privately held debt will be written down by as much as perhaps 50% as soon as next week. But that on the other hand, Greece will under no circumstances leave the Eurozone. And I very much disagree with what Desmond says, that what the EU and the IMF is offering Greece is a great recession. That's absolutely not the case. They are offering to continue to fund Greece at essentially German interest rates for the foreseeable future, as well as ongoing fiscal transfers through the EU budget, if need be, in perpetuity. Because the real contagion, and here I agree with Desmond, is the real contagion for the Eurozone only emerges if a country actually leaves. That's what can create a kind of uncontrolled contagion scenario where markets will fundamentally lose confidence in the entire construction, and that's not something that Germany, France, or any of the other countries can survive. So yes, Greece will default, but it will absolutely stay in the Eurozone. And finally, the idea that Greece has any economic benefit outside the Eurozone, I regard as essentially misguided. Greece had an export ratio to GDP in 2010 of 8%. This isn't a country that can export its way to prosperity, even if it gets a 50% real devaluation. It just doesn't export anything that the world really wants. The only thing it really exports is shipping services, which are denominated in US dollars around the world. So the domestic currency of Greece is relatively irrelevant for the competitiveness of that. And then it's tourism. Now, tourism, clearly, if the domestic price level in Greece fell by, say, 50% vis-a-vis the other Mediterranean countries, would have an effect. But tourism is also very, very susceptible to social disturbances. You're just not going to fly into Greece if there's tear gas flying through Athens. And I think if you were to leave the euro, that's quite clearly what would happen. So it's not in their own interest. And the idea that there is some sort of pot of gold at the end of the devaluation rainbow is a myth.
Thank you very much, Jacob. And Antonio, I think I know what you're going to say. What is the likelihood?
Not necessarily.
Okay. What is the likelihood that the euro will remain in its current form? What is your subjective probability?
At least 100%.
At least.
Okay.
Since you allow for some subjectivity.
All right.
No, I mean, on the same grounds as Jacob said, I mean, it's not in the interest neither of Greece and Portugal. I mean, the problems are not being in the euro or being outside the euro. The euro is not the panacea it's not a substitute for good policies. Therefore, I mean, they will have to run the good policies I mean, inside the euro or outside the euro. And inside the euro, they have the assistance of the European Union plus the IMF, not only financial assistance, but assistance to overhaul the country, to overhaul the economy and the economic structure, so that they can grow, they can go back to grow, and they can be on a sustainable path.
Thank you very much. Okay, I'm going to group my questions, the remainder of my questions, in three. First, I'm going to ask a short question about causes. What is causing this problem? What are the fundamental causes? But I want to spend most of the time on short-term solutions. Short-term solutions first, and then long-term solutions. So the short-term fix, financing, support, et cetera, and then long-term fix, institutional change, so on and so forth. That's the structure: causes, short-term, long-term. So let me pick a couple of our panelists on the causes issue. So my question is, what's the problem anyway? Is it fundamentally a competitiveness issue that the peripheral countries are confronting? Or is it a fiscal issue? Or is it a banking issue? And maybe, I don't know, you have other causes. And let me start with Jacob and then ask Desmond also to address this question.
No, I mean, I think you know, we need to distinguish. This isn't just one crisis. I mean, if you look at a case like Greece, it's quite clearly a fiscal and a competitiveness issue. If you look at Ireland, well, it's quite clearly a banking system crisis. If you look at Portugal, it's probably more like Greece. If you look at Spain and Italy, it's predominantly a competitiveness issue. So it's a little bit of all of the above, and then combined with what I think is pretty obvious, that Europe is under-institutionalized. The euro, as it was described or as it was created in the mid-1980s, did not and has not had the institutional structure to withstand a serious crisis. So, you know, it's all of the above plus, you know, wrong design, if you like.
Desmond?
Yeah, no, I'd agree with Jacob that, you know, I think it's a mistake to look for a single cause of the crisis or a single symptom of dysfunctionality, you know, that you've really got imbalances, the size of which in my career at the IMF I've never seen, in a serious country, anything of the sort, that when you're looking at a government, when they're supposed to be running a 3% of GDP budget deficit and they run a 15% of GDP budget deficit, the debt level is supposed to be at 60, it turns out that it's at 170. If you look at the balance of payments side, I'd say that countries like Spain have got huge balance of payments problems, running very big external current account deficits still at this stage, and got an external debt that is over 100% of GDP. So there are huge imbalances. So I wouldn't want to look at it simply. I think that the more interesting question is, how did we get to this pass? What went wrong? What was the breakdown? Why was Maastricht criteria not applied? Why did the markets not discipline these countries? And I think that there's a huge amount of government failure, a huge amount of market failure, and we're in an unholy mess. But there's just one point, if you'd allow me, just to say that the IMF is not offering Greece a Great Depression. Well, you're not really looking at the facts. Greece's economy has fallen over the last 2 years by 14%. Its unemployment, should I say by 12%. Its unemployment is over 15%. And what the IMF is coming in to tell Greece to do is, why don't you have another round of real fiscal austerity in these kind of circumstances? You're really just going to drive that economy totally into the ground with these sort of policies. And I'm afraid that the same is true with Portugal. Just one other point, if I may, is the damage to the system is not from a country leaving the euro. I think that is a second order question. The damage that Greece will do and where you'll get the contagion will be when Greece defaults in a major way. And then when that causes a banking problem, that is what's going to cause contagion. That is what the ECB has been emphasizing that they're scared of. That's why they don't want Greece to default at all. But if you have a hard default, whether the country stays in the euro, whether it doesn't stay in the euro, is secondary. The damage is done by the default. That really impacts the banks in the core.
Okay, good. So we've learned today a new word, under-institutionalization, and a new disease. So, if one of your children or your friends looks to you to be under-institutionalized, please call the Peterson Institute right away. Take it on an emergency visit. I love under-institutionalization. All right. Let me now move to short-term fix. Short-term fix. So the first question on the short-term fix is that now the big debate is around the EFSF. What is it? Financial Stability. European Financial Stability Facility, right? Mm-hmm. This is the financial backstop Europe created back in May 2010 and then has decided to strengthen in July 2011 in order to prevent contagion from spreading further. What changes should be made to the FSF to make it more efficient? And I'm going to ask Antonio and Liliana to address that question. Antonio.
Well, the changes that have been already agreed are to increase the capacity, and that was already agreed and ratified. It will also be able to intervene on a precautionary basis. It will also be able to intervene to buy government bonds. And it will be able to intervene to support banking systems when in need and when there is a financial stability risk for the euro area. So these in themselves are what it takes to provide this backstop for and to avoid contagion. As you know, there is now the discussion on by how much and how will it be leveraged so as to have the adequate capacity to deal with more important both banking and sovereign problems. But these are the changes that are already in the pipeline and that of which the modalities are being discussed.
Thank you. Liliana, do you want to elaborate?
Absolutely. I have big issues with the EFSF. I think that a mechanism that uses resources from the same debtor countries to finance those that are in debt is weakening the stronger countries. Let me explain. If I am Italy or if I'm in France, and I'm using part of my resources through the EFSF, which is just a vehicle, right, to help Greece and help Portugal, the markets know that me, Italy, and France are increasing my liabilities, right? And if they default, my contingent liabilities are even greater. So it's even worse when people talk about leveraging the EFSF, which means that, okay, first, let me back up for a second. The EFSF does not have right now 440 billion. They have already committed more than 200 billion, so it's much less money, first of all. Second, if you were to leverage that, that even implies creating kind of a toxic asset. It's the equivalent of a toxic asset, which now is a highly leveraged toxic asset. The markets perceive that, and therefore the credibility of the new instrument gets destroyed. Okay? Why? And what you asked for a short-term solution, and I hope also you asked me about the banking.
I will.
Okay,
I will.
good,
Don't
good,
worry.
good.
Don't worry.
Okay, but I want to finish with the AFSFS, something else. This is not the same as when the United States TARP was put in place. At that time, you need to recall something. Nobody was doubting about the debt sustainability of the United States. That was not an issue on the table. Perhaps as a long term, but that was not an issue. So the government was able to make that transfer to the banks. But that's not the case in Europe, where sovereign debt problems and banking problems are completely intertwined. Okay? So the only solution for me that can actually bring help, support to the European problem right now is fresh external money. You cannot help yourself when you are sick. You need a doctor from outside, okay? So if, as Desmond said, many countries in the world, including the United States, are going to suffer contagion from this, we need fresh commitments from the US, the UK, Japan, and the IMF mobilizing these resources. And Germany, of course, which still holds some credibility. I said some because it's decreasing by the day. But the bottom line of what I just said is I don't believe that the Eurozone problem can be solved with only Eurozone money.
And I am going to come back to that later. Let me ask now about the other short-term fix everybody's talking about, which is the European Central Bank increasing its purchases of government bonds, or for that matter, increasing its lendings, liquidity support to the banking system. So my question is, what is the appropriate course of action for the ECB, and will it take it? And here I'm going to ask Desmond and Jacob, perhaps, to address this question.
I think that the ECB is very uncomfortable doing these purchases. What we've seen over time is they enter into this market very reluctantly. They enter in extremis. I think that I would perhaps disagree a bit with what Liliana said, in that I don't think that there's an alternative but to leverage up the EFSF if you don't want contagion to Spain and Italy. If you don't have a real firewall for Spain and Italy, it's going to be game over for the euro. So the ECB would prefer to see this done by governments through instruments like the EFSF, rather than the ECB compromise its functions as a central bank. What you're doing is you're compromising the independence of the central bank. You're making its monetary policy a lot more difficult. This is not something that the central bank should be involved in on a permanent basis. Having said that, the Europeans, the policymakers are likely to fall short, so they're likely to leave the ECB once again in a position where the ECB is given this terrible choice between standing on the principle of its independence and good monetary policy and letting the whole structure fail. So I think that when the ECB is pushed, the ECB will come in at the last minute and prop them up the way in which they've been doing before. But I don't think that that is the way to go. I think that if you're wanting to try to save the system, you really do have to come up with a firewall of something like at least 2 trillion euro. Otherwise, you're really going to get real contagion like we saw in July and August on Spain and Italy. And if Spain and Italy were to fail, that would be a total disaster. So, if I were sitting in Berlin, the trouble is that politically it's very difficult to do this, because 90% of at least try to say 70% of the electorate in Germany don't want to do this. And as far as the ECB goes, it's very difficult for the ECB to pursue a line when not only does Axel Weber not want to do it and Jürgen Stark, both of them leaving the ECB, but the president of the Bundesbank doesn't want to do it, Ottmar Issing doesn't want to do it, the whole German establishment, monetary establishment doesn't want to do it. So they're going to be very reluctant to get into supporting Spain and Italy, which means that they're going to be too late, too little, that this thing is going to just fester.
Thank you, Desmond. Jacob.
No, I find myself in surprising agreement with Desmond. But I think it's important to distinguish between what will be the optimal position for the ECB, the policy action for the ECB to take to finish the crisis, or end the crisis as soon as possible, and what is optimal for achieving what the ECB actually wants. Because if the ECB wanted to end the crisis, what they would essentially be able to do is they could break very blatantly Article 123 in the treaty and just say, look, we stand fully behind all Italian debt. They could do that. They might be sued under the European court, but probably nothing would come from that. So the ECB has the ability to end the crisis if they want to do it. But I would contend that they're actually not interested in that. Because if you look at the ECB, you have to think of it, it's not a normal central bank. It's a central bank that is so independent that is essentially unaccountable to anybody. They send letters to policymakers, not like in the US, where obviously the Federal Reserve receives letters about what they should do from congressional leaders. It goes the other way around. So what if you look at what the ECB has been doing throughout this crisis? It has essentially, I would argue, proven to be a conditional lender of last resort. Which is what happened, obviously, in May 2010, when they first initiated the security markets program, and it's what happened again in August this year, when they agreed to expand the security markets program to include non-program countries, first and foremost, of course, Spain and Italy. And if we look at what is going to happen going forward next week, if this is your strategy, the ECB strategy is essentially to put maximum leverage on governments to do what the ECB wants them to do, which is to put in place binding constraints on the Stability and Growth Pact, put together a longer-term fiscal, what the ECB or the Trichet calls a European finance minister, and then implement a lot of structural reforms. So what they're going to do is they're going to, unfortunately, if you want to end the crisis, they're going to refuse to leverage up the EFSF. That's very clear. What they want instead is this EFSF bond insurance program for new primary issuances of debt, so that the EFSF insures 10, 15, 20, 30% of these primary issues. Because what does that amount to? It essentially amounts to governments, the euro area governments, self-insuring their own primary issuances, which is the functional equivalent of actually strengthening the enforcement of the Stability and Growth Pact. What the ECB is going to offer to that deal is they're going to not say it out loudly, but they're going to leave the securities market program intact. which means that at the end of days, the ECB will still ride to the rescue of Italian and Spanish bonds if a true crisis comes. So as I said, there is a distinction between ending the crisis and achieving the outcome that the ECB would like.
Okay, at some point I will encourage our panel to come back to this, to Jacob's assertion that the ECB could end the crisis today if it wanted. I will ask them to come back to that. I think it's a very, very important and controversial point. But let me just continue with my line for the time being, which is to ask Liliana what action must be taken to shore up the banks in Europe.
Okay. One of your questions was, do we have a fiscal crisis, a competitive crisis, a banking crisis, or whatever? When I read your questions, my first reaction is, who cares? Once it gets to the banks, you focus on the banks. Why? Because behind the banks are the world payment system, right? I mean, basically, you cannot do any kind of transactions if they are not done through the banks. So once you hit the banks, then you have a banking crisis. People are talking about the formation of a banking crisis. That's nonsense, right? We're in the middle of a banking crisis right now. Some people can say, well, but I don't see huge runs out of the banks. I've never seen a banking crisis that starts on the liability side. They always start on the asset side. And the asset sides have a lot of problems. Some of them made by their own countries, including in Spain with the lending to real estate, but most of them because of the large holdings of government securities, which are in trouble these days. Now, when you get to that point, then you move to banking crisis resolution. Banking crisis resolution is very hard and requires a lot of political will. And the first step, there are two steps that needs to be taken. The question is, how do you do it? And we have examples in the world on how to do it right. The two things that needs to be done is the banks need to be recapitalized, and there have to be huge debt haircuts. Okay, now let me explain. To ask the banks recapitalize yourself is again an illusion, because that's like telling the banks, go to the private markets and borrow. No, the private markets don't want to lend the money. So that needs some form of government intervention, right? People say that's going to be nationalization. Yes, temporary, but that's the only way to go. First, you have to recapitalize. Why do you first have to recapitalize? Because first you need the banks to be strong to then hit them. How do you hit them? Through the debt haircuts. The debt haircuts means basically that what they have or what they think they had as assets is worth much less, right? Why are you doing that? Because you are now transferring what I just first said that is absolutely needed, and it's a transfer from creditors to debtors. That has to take place for a resolution of the banking crisis. In the United States, one mistake was done. We still are not totally out of the banking crisis. And the reason is that you still have a problem with the mortgage markets. And Fannie and Freddie has not been resolved yet. So there has not been enough transfer from creditors to debtors, and that's why we still have problems in the United States, and those are constraining the growth of the economy. Okay, we need to think, in the case of Europe, exactly in the same way. We need to solve the banking crisis, which implies a transfer from creditors to debtors. Private holdings of banks are going to suffer big losses, and recapitalization has to come from national money because private money is not available right now. I told you that there is a lot of stories about how to do this. I just want to tell you a story from Brazil.
Short, please. Short.
Very short. The problem was different. But Brazil had to devalue in 1999? Yeah, it had to devalue, okay? There was no way out. I'm not talking devaluation now in the European. The problem was that if it was going to devalue, because of the composition of assets in the banks, a banking crisis was to emerge. Arminio Fraga was the president of Central Bank of Brazil at the time. He did something. He first issued a large amount of dollar-denominated assets and placed it in the banks, basically shield the banks, then devalue. And Brazil has passed in 1999 as one story in which there was a currency crisis but not a banking crisis. It was because the president of the central bank took the right action to protect the banks. Okay, we need to think in that direction to solve the problems of the banking system in Europe now.
Okay, thank you very much. My last question, and then I'm going to come back to monetary policy, under the short-term heading, the short-term fix, is related to Spain and Italy. Everybody knows that an important part of the solution is adjustment in the periphery countries. And Spain and Italy are huge countries, and much, much bigger game than Portugal, Ireland, and Spain. Portugal, Ireland, and Greece. So I want to ask anybody in the panel who wants to take it on, are Spain and Italy, in your view, doing what is necessary to adjust? Go ahead.
No, I mean, I think it's pretty blatantly obvious that Italy is not. Because Italy has a structural growth problem more than anything. They don't actually need a lot more austerity. But the Berlusconi government has clearly put in, has not moved down that in that direction in the many years he's been in power. So I think it's fair to say that Berlusconi needs to go before anything sensible can come from Italy. In the case of Spain, I think it's fair to say that you've had a fair amount of reforms taking place since May last year. The Zapatero government has begun to liberalize the labor market, and I think has probably done as much as a socialist government can be expected to do. And then finally, they've also moved to put in place a constitutional debt limit similar to one in Germany. And then Zapatero decided he cut public sector wages, which is political suicide for any socialist government. And he basically called an early election, which he knew he was going to lose. So he fell on his political sword, leaving the way for the PP to emerge and continue the consolidation, the reform efforts. So I'd say in Spain you've done most, but Italy is clearly lagging behind.
Good, thank you.
I would take the other side of that analysis, that I would think that Italy is okay in a relatively good state of the world, that they've got a very high debt level, but Italy's been running a primary surplus. So if Italy were to have growth and it were to have a favorable external environment, I wouldn't be that concerned about Italy. Part of the reason for my concern about Italy is that what we're now doing is we're seeing, partly for the reasons Liliana's mentioning, that you've already got real strains in the banks, you've got a real credit crunch that's developing, and you've already got clear signs that France and Germany have basically run out of steam. It's only a question of time before France and Germany go into recession. So that's the reason that I'd really worry about Italy, is that it's something external. Spain is a lot more complicated. Spain had the mother of all housing booms that they financed from abroad. So Spain is stuck with house prices that still haven't adjusted. Spain's house prices have probably got to fall another 30%, and they're expected to take fiscal adjustment, fiscal austerity for a number of years in that kind of environment. I just don't see how Spain is going to grow. And likewise, Spain's just got a huge external debt problem. I don't see how you get out of that by just crunching the economy, because if you try to crunch the economy, what that's going to do is it's going to then exacerbate your public finance problem. So if you've got a public finance problem, a housing sector problem, and a huge external problem, not to be able to write down your debt and not to be able to devalue the currency, you're really in serious trouble.
Okay, good. Let me ask, oh, you wanted to come on this?
Just,
Yeah.
just for a
Yeah.
second.
Yeah,
Just to underline that the case of Italy and Spain is much different from the one of the other countries. In the case of Italy and Spain, it's not a problem of solvency, it's a problem of liquidity. And the measures that are being taken are such that, I mean, they try to reassure the markets that the government has the capacity to rein in the economy. And secondly, especially in Spain, they are also overhauling the structure of the economy so as to promote that growth that is desperately needed for the next few years. So this is, I mean, I think that putting them together is an error.
Thank you. Let me come back to Jacob's point. Is it true, and ask the other panelists, anybody who wants to kick in, is it true that the European Central Bank could stop this crisis tomorrow by issuing a blanket guarantee that it will purchase the government bonds of the countries in trouble? Anybody want to take that?
Yeah.
Liliana.
No, I don't agree. I don't think that the ECB is like the Fed. If you look at current data right now, and the only thing I hate about not using PowerPoint, I have such a bad memory that I don't remember any number. So, but what you are seeing is that the holdings of euros as foreign exchange reserves in the world is declining. I think that a blank check without proper correction of fundamentals will not solve the problems in Europe, because in contrast to the Fed, which is by definition, only because there's nothing better, the safest asset in the world these days, all this is man-made, so, but right now it is perceived as the safest asset in the world, and there's a run towards there. A huge blanket guarantee at the end will imply a run out of the euro. This is not, when you have a crisis, and I have to go back again to the banks, when you have a banking problem, then the increase in liquidity, the buying back of assets, that does not solve the problem. You need real capital. Otherwise, banks are not going to lend. You give more liquidity to banks, banks will save the same way they have been doing in the US for a very long time. So the resolution of this problem starts with the banks and ends with the banks. The European Central Bank has a very important role to play. It's a provider of liquidity. So when liquidity is needed, it helps. But it would be a big mistake to think that the actions of the ECB are similar to the actions that can do the same actions that the US Fed can do.
Thank you. Desmond.
Yeah, no, I would disagree. I'd say hypothetically, there is a very easy solution to this problem, that you can push this problem many years, is if the Germans were one way or another prepared to write a blank check to these countries, you wouldn't have a problem. You would just finance it, you could keep their bond levels at that side. And Germany initially would be capable of doing it because Germany's public finances are very much better than those, for instance, of the United States. I realize I'm setting the bar low, but Germany does not have an 8% of GDP primary budget deficit like the United States does. It does not have as high a level of budget of public debt. So they can do it either directly through writing a check through the EFSF or ECB, whichever mechanism they like. If they were to finance it that way, you wouldn't have a problem. The Germans, of course, the citizens understand that if you go that route, what you'd be having to do is you'd be having to write a check year in, year out, forever. Eventually it'll sink you. So the discussion is it not better just to cut loose, recapitalize our banks, and then we've got some kind of resolution to this problem. But theoretically, you can do this.
Sorry, I didn't quite understand. Are you agreeing with Jacob or not? He said that the ECB can today stop the crisis.
Absolutely. Theoretically, the ECB can do it. But what I'm saying as well is that you've got to be looking at ECB in a political context. The ECB, like the Fed, can expand its balance sheet until the cows come home. you want 2 trillion, you need it. You want 3 trillion, you just use the printing press to do that. You can do it. The ECB is not going to do that because its major shareholder, the Germans, that is not their view as to the way in which a central bank is to be run. So, one's raising a very theoretical question. Practically, the Germans have got a constitutional court that would have problems with debasing the currency or not doing independence. You've got the Bundesbank that is it's apoplectic about what's going on right now. If you went that direction, the Germans would really have trouble staying within this union.
Okay, anybody else? Antonio? Yeah.
Yes. Yes, one point relating to your second question. To the extent that this crisis is fiscal, structural, banks, and institutional, I mean, one single measure and one single institution cannot solve it. So, yes.
Okay, so I want to come back to Jacob, you had...
No, I mean, I just want to emphasize what Desmond also said. I mean, when I said that the ECB could end the crisis like that if it wanted to, I'm not talking about that the ECB can make Greece competitive overnight. Of course it cannot. But what it could do, in my opinion, by issuing, for instance, a blanket guarantee to the Italian debt, it could basically make Italy trade much more like the UK. Than it does today. Because if you look at it, why is the UK, given its fundamentals, et cetera, raising 10-year debt at, 2.5% in the markets, and Italy is about 5 or 6%? Well, I would contend that it has a lot to do with the way the markets perceive the role of the central bank backing the pound and the euro, respectively. That the ECB could, if it wanted to, change. But I agree with Desmond completely that for political reasons, they obviously won't do it.
Okay, all right, good. What I'm getting from this discussion on the ECB, which I think is tremendously important, is what I'm getting from Desmond and Jacob together is that in the end, this boils down to the same thing as saying the Germans and the other core countries have to expand the FSF, have to issue Eurobonds or whatever it is that the solution is, because in the end, the ECB will have to be backed, so to speak, by the whole of the Eurozone. And this backing, so to speak, can take the form either of financing the European Central Bank's deficit or taking an inflation tax, basically in the form of higher prices. One way or another, the European taxpayer pays, and therefore it becomes a political decision. And the political decision so far has been, no, we're not going to accept that kind of burden. Okay, so that does the short-term questions. Now I'm going to ask one question about the long term, and then I want to open it up. All the things we've talked about, are about how do we stop this thing over the next year or two? How do we tide the countries in difficulty over? But this is a very different question than what should this European Monetary Union look like in order for it to be a sustainable thing, not over the next 2 years, but over the next 50 years, 100 years. What is the shape of this thing? What is needed in order to make sure we don't get into this problem again in a big way, assuming we can get over the current crisis? And some people, Desmond obviously believes we can't get over the current crisis anyway. But let's assume that you can for a second. Well, how would you design it now? What would you do differently? I want to stress this question because so much of the action has been oriented towards the short term. And clearly not enough attention is being given to what does this thing look like in the longer term. And until I think markets have a sense that this thing is sustainable in the longer term, they're going to be very nervous about the short term.
No, I think it's exactly
yeah.
the reverse. That
All right, go ahead.
markets don't have got real concerns about the short term as to whether you're going to get towards the longer term. They just find it fanciful when you're talking about what are you going to do in 2013 or 2014, how are you going to design this, or you've got a fire, that this thing is a real conflagration, that the market thinks that you haven't got ahead of this crisis one bit. From the beginning, May 2010, each time the policymakers have fallen short of getting ahead of the markets. The markets have still got the question, is this really going to survive? But if I would just say, to answer your question on the long run, I think that what you'd really have to do is go back to basics about the optimum currency theory of a monetary union, that for a monetary union to work, you've got to have conditions satisfied for that. You've got to have the wage flexibility, you've got to have the labor mobility, you've got to have a fiscal federal union, you've got to have countries that are similar in kind, that will actually be playing by the rules. So my answer to your question is that for the euro to survive in the long term, what you've really got to do is you've got to strip out the countries in Southern Europe. You've got to have a core, a reduced, go back to your original euro, the strong countries that can abide by this, that have got similarities. Then you've got a currency. I wouldn't be surprised if that's where we're going to be in 5-10 years' time. That's probably too long, 2 or 3 years' time. Is we'll have a strong euro. With the countries in the north, and that'll be a very serious country. That could really be a proper reserve currency.
Anybody else on this question of the long term? What is needed, Antonio?
Yes, and let me come back also to your first question of whether the euro will survive. I mean, it's not a question of surviving, but the euro will take the opportunity to come strengthened from the crisis. And how? By completing the institutional setting. You call it under-institutionalized. Well, is it a disease? Well, it may be a teething problem. But so it is clear that we needed some more cohesion, some more integration to avoid countries going their own way and disregarding the effects on the others and disregarding the sustainability of their policies. So this, to some extent, is now in place. Only 2 weeks ago, a series of measures were approved in order to restrain the possibility of these slippages. So that's one part. Probably it's not enough, but going back to theory, to the optimum currency theory, it misses a crucial point, which is the political aspect. And I'm sorry, but this is what binds people together, and you cannot disregard that. I mean, the countries of you call the periphery will not leave the euro, so you need to take that into account if you look beyond. I mean, countries, the public opinion in the countries may be upset about the euro area or the euro authorities, but they are much more upset about their own national authorities. So, and the latest Eurobarometer, the poll of European public opinion, shows clearly that people believe that it is within the EU that they may solve better their problems. So, but indeed, I mean, for that to work, you need some more constraining instruments and institutions, and this is what has partly been done and is probably more in the making.
Go on, Jacob. Please tell me also if, in order for the euro to be viable in the long term, we need to have a fiscal union.
Yeah, no, I mean, I think that, we can all debate for a long time, what does a fiscal union mean? But I mean, at least for me, what it means is that you need to give the center, or Brussels, or whatever you want to call it, the ability to overrule national government budgets. essentially veto them. And I would probably disagree somewhat with Antonio that the current six-pack is not nearly enough for that. You basically need to have what's now called the European semester with a veto power, meaning before it becomes national budgets. That will clearly require a new treaty. I think that kind of treaty will have to, in my opinion, to be approved by national referendums in all countries. Not just in some of them to have the proper electoral anchoring. If you read the German Constitutional Court, it'll probably, this type of fiscal union would also require a change of the German constitution requiring a referendum. Clearly, I think you will need to have common centralized banking regulation and essentially a European FDIC version. Because of the size of the banking system, it makes no sense to have it sort of essentially continue to be backstopped by national governments. That's simply too big. It would be too unstable, and the risk for capture of national regulators is too big. So if that's I think that's the two main parts of it. And then of course you need to have all the things that national governments, in terms of structural reforms, need to do anyway. That's another given, which you clearly will have to address.
Yes, Liliana. Yeah, quickly.
Just one small thing. I think that regardless of what we dream the Eurozone could be, if we could redesign it again, the way this crisis evolves is what is actually going to determine whether there will be the same kind of structure, the same kind of countries, or whether they will backtrack completely from initial intentions. I agree very heavily with what you said about the political differences between countries and willingness. Remember that when these things happen, we will have a new government in Spain. We don't know what's going to happen. I mean, Merkel will be out of the game too. So the whole political spectrum would be completely different. And so dreaming about what the new stable long-term Eurozone would be, it's fun, but I couldn't tell too much.
Okay, very good. So I'd like to open it up. I do have some more questions. I have many more questions, but I will hold off and open it up for you, for the audience to ask. Yes, sir. Yeah, microphone, please. Gentleman here. Can you please introduce yourself?
Okay, my name is Stanley Kober. One thing that hasn't been discussed yet is population movements. And I am hearing about younger people leaving, not seeing any opportunities. And if that's the case, that would affect any scenarios for economic growth. If the talented young people leave, then where will the growth come from? How will the transfer payments for Social Security and healthcare be paid?
Yeah, Jacob, you want to take that?
Well, I think two things there. One thing to keep in mind is actually that the legal immigration inflows into the EU 15 have actually, in the last decade, been about twice the level of the United States. So this idea that in the aggregate that everybody is leaving the EU is actually not empirically founded. Secondly, I think it's an important aspect to note that the reason that many young educated people in Spain, Italy, and the periphery are leaving is in fact that you have these archaic insider-outsider labor market structures that grossly favors essentially the baby boomer generation, because these are the people that have very well protected jobs for which they are essentially unfireable. But it's the young people that are denied these contracts because they're very expensive contracts. So obviously, employers are very reluctant to hire new staff on them. So therefore, young people are essentially condemned to remain outsiders and be on very short-term, part-time contract at much lower wages. But this is essentially a structural reform issue, which simply, in my opinion, shows that the labor market reforms, particularly in the southern part of the Eurozone, has not gone near far enough.
Yes, the lady at the back. Oh, sorry, the gentleman, sorry about that, yeah.
My name is Rolando Sofsky, and on the point of the leveraging of the FSF, I think I would agree very much with what Liliana said, and frankly, there's something I don't understand, because I don't see how you can guarantee your own debt. If we are going to guarantee the debts of France, Italy, and so on, who is left to do the guaranteeing? Secondly, it seems to me that there were some fairly definite and definitive statements by the German Minister of Finance to the Bundestag and the ruling of the Constitutional Court as to how that could be possible. And I'd like to know the panel's view on whether the leveraging of the FSF could be done after what was said in Germany last month. And finally, it seems to me that this would also require the approval of national parliaments, and we already saw one country with a political crisis last week for a much smaller increase in the capacity of the FSF. So there are also important political issues behind the leveraging of the FSF that should also be taken into account.
Good. Anybody want to pick that up? Go ahead, Desmond.
Yeah, I'd just take the point of view of how, I just answered the question, how is Mrs. Merkel going to be able to do a U-turn given what she assured the Bundestag to get the July 21 measures approved, that it wasn't just her, it was the Minister of Finance, that there were statements from the Constitutional Court, the head of the Constitutional Court, that the Germans politicians mustn't try to pull the wool over the eyes of the taxpayer by using these kind of mechanisms. I think that when conditions change and when you've got a big crisis, your position is going to change as well. So I think that basically the way in which this will work is Mrs. Merkel will make a U-turn out of necessity, but what she's going to do is she is going to offer the Bundestag in return that they're going to have a say over how the EFSF's money is going to be used. What that does is it reduces the ability of the EFS to be a real bazooka. That's really what you're wanting is you're wanting like what the Swiss central bank is doing right now is the Swiss central bank is saying that the exchange rate of the Swiss franc to the euro is 120, and we've got a printing press, and we'll use that printing press to print as many Swiss francs as it's going to take to keep the rate at 120, then that is a credible bazooka. Even if you manage to leverage up the EFSF to 2 trillion euro, but you say each time we're going to dribble out a little bit of money, we've got to get the Bundestag to agree on the conditions we're going to impose on Italy and Spain, that is not really going to convince markets that you've got something ready there. And at this, I should really just say that I agree with Liliana. Just in terms of the EFSF, while what they've done is glacially they managed to increase it to the effective size of 440 billion. But what they've done is they've already committed something like 120 billion to Portugal, Ireland, and Greece. What they've done is they're saying that they're going to use it to infuse capital. So they don't have more than around about 250 billion to leverage up. And it's fanciful to think that you're going to be able to leverage this up 10 to 1. So I'm not holding my breath for an effective bazooka.
Okay, so at some point I want to come back and ask the question, who in the audience has 2 trillion euros to provide? And where do we find the 2 trillion euros? I will come back to this. It is a serious question. Yes, Sandrine. Please state your affiliation.
I'm Sandrine Rastella with Bloomberg. I'd like to go back to what Liliana said earlier about the need for Japan, the UK, you name it, to help in the European debt crisis. We've had quite stern statements at the G20 last weekend that the Europeans have to do their homework. Japanese, US saying the IMF doesn't need more resources. So I'm curious to see where you see that going. Is it just a lot of posturing on the part of countries waiting for Europe and waiting for the EU summit, or are we really stuck, and where do you see that going?
Yes, as I just said, I really think that the solution is a global solution as opposed to just coming from the countries in Europe. And before just getting exactly into your question, the reason why I was disagreeing with the ECB being the final solution to the crisis is just following Desmond's own argument. The markets know that at the end of the game are the German taxpayers. And do the German taxpayers will have all the money that is needed to be writing the check year after year? The answer is no. So they bring that to present value and says, not even Germany will be able to do it. That's why I bring it to the present and say, no, the ECB alone cannot do it. Okay. Starting from that perspective,
Okay.
then I need fresh money. Every crisis in the past has been solved with fresh money, meaning money that is not from the same people that are in the game. And when you look at the statistics about the amount of Eurozone government debt held by the US and other countries, is large. So the global system has a stake in this crisis. That's why I think that you need the participation of other large economies. Japan plays a role too, and Japan has a lot of, Japan has a huge amount of debt, but very little of that debt is held externally. So it's in quite a good situation from that perspective. And the IMF, you need a coordinating institution, right? The IMF is the coordinating institution at this moment in time. There's no other coordinating institution. It's not that I've seen that the IMF is, I mean, Desmond and I have worked many years. There's no that we've seen that, that's God's made institution. It's just the institution that we have at hand. Yes, you're right. People are waiting because the Europeans themselves are claiming that there's their own problem and it's going to be solved within Europe. Right? I mean, there's not even requesting. I mean, extend the lines of credit from the IMF so that there could be help to the euro crisis. But from my perspective, the crisis needs an outsiders. And,
okay, I want to ask a question and interrupt the flow. All right, so IMF has the 2 trillion euros. Actually, it doesn't.
No, it doesn't.
But if Japan, Germany, everybody, China, US, etc., is willing to give the money, maybe, I don't know if we need 2 trillion euros. I got up to $2 trillion in my own calculations. But look.
Well, it's soon going to be the same.
Yeah, well, all right. He has an answer for everything. So the 2 trillion something. So the IMF has, now I want to ask the panel. So I am China, I am Japan, etc. Am I just going to give the Europeans $2 trillion just like that? If I give you $2 trillion to solve your crisis, Antonio, if I give you $2 trillion, I want to do something different than what I've done with Greece, Portugal, and Ireland, where I basically put conditions on Greece, Portugal, and Ireland. If I give you $2 trillion, if I give you $2 trillion, I'm going to put conditions on Germany. I'm going to put conditions on France. I'm going to put conditions on the European Commission and the European Central Bank. And I'm going to say to them, this is the way you have to solve this problem, because it is a German problem. It is not only an Italian, Spanish, etc. problem. So my question for the panel, is that fair, number one? And number two, if it is fair, can the IMF do this? Or is the IMF not equipped to set those kinds of conditions?
Well,
Desmond,
I don't think,
go ahead.
I would just start by saying that I'm not sure that the IMF has covered itself in glory over the past 18 months. So to think that they're going to have a solution going forward, that they should have recognized, that this thing doesn't have a solution without a serious write-down of the debt and probably without some of the countries leaving the euro. So I don't have that much confidence in them. But the issue as to other people stepping up to the plate with big amounts of money, you're talking about burden sharing. Why is it that they should be left holding the bag? Geithner knows full well that the chances of the United States making an additional appropriation for the IMF with the present Congress are close to zero. So you can't go that route. And I think, as a taxpayer in the United States, I think that for them to keep kicking the can forward with my dollars, I would be voting against it. All you're doing is you kick the can forward, and I'm going to get left holding the bag, which I don't want to do.
Anybody else on this?
Yeah, I mean,
Jacob.
first of all, I agree completely with Desmond. I mean, there's no chance that that Geithner or the administration is going to get Congress along with that. But on a broader point, I would think from the perspective of Europeans, yeah, I mean, if the rest of the world want to come in with a pot of money, I'm sure they would take it in some shape. But I don't think it's credible. And I would also contend that, I don't think it's necessary. I mean, the euro area is essentially an external surplus, has a sizable net external investment position positive, and has a primary balance that's relatively close to zero, at least compared to the other industrialized countries. So the idea that what the euro area needs to do is to figure out how it wants to distribute its finances. If it wants to continue to finance Greece in perpetuity and can find a way to make that sustainable, that's what it should do. I mean, this is the institutional problem in Europe. It's one of redistribution. I don't necessarily think that it's one of actually lack of actual resources. And I mean, I think the idea that BRIC countries and other large industrialized countries should come to Europe with a pot of money, I just don't think that would fly in any of the domestic constituencies in any of these countries.
Liliana?
Yeah, no, that's why I had the IMF in there. I am really thinking not so much in countries coming unilateral. What I'm thinking is on the expansion of resources that the IMF has. In other words, remember the bazooka? I don't think the Europeans have it. That's basically my bottom line. So if I need a bigger bazooka, it's precisely so that I don't use it, right? But it has to be very big. And yes, I'm totally aware of the Congress, of the situation in Congress in the United States. I'm well aware of that, but we're looking for solutions right now. We're aware that the ECB doesn't want to do what you are proposing that needs to be done. So we're aware of that constraints. But in this panel, we're discussing about potential solutions.
But I think the bazooka is only really required if you want to end the crisis. The only institution that has 2 trillion euros is the ECB. Nobody else. Everything else is fanciful.
Antonio, do you want to?
Oh, yes, I mean, sometimes I feel that the EU is considered as a small country. I mean, it's almost 1/3 of the world economy. So there is wealth enough, I mean, to cope with our own problems. All the rest is based on assumptions that this country is not going to do this, that that country is not going to do that, that this institution is not going to do this. I mean, we have seen that institutions and countries have been pragmatic since the beginning of the crisis. So, again, the assumptions that Greece will need transfer, I mean, forever, are again based on the assumption that Greece will not change its economic structure, that things will go on as they are, and they are not. I mean, there is the consensus, there is the understanding that there were problems, and these problems must be solved. And I mean, much of the reason why the solution is not yet there, it may be next Sunday, is because it's complicated, both technically and politically. But the will has been made clear, that the leaders have made clear that they will be up to their job, and now they are working out how to play it. So I think that's the answer.
The gentleman at the back.
It's always seemed to me that.
Please introduce yourself and affiliation.
Glenn Miller from MTB Investment Advisors. It's always seemed to me that the Brady Bond plan of the 1980s was maybe a successful precedent for what's going on now, for resolving what's going on. I'm wondering if any of you could comment on that. It's sort of similar to the bond insurance plan to a certain extent, but it seems to me that there's some possibilities there for using something like that as a resolution.
The Brady Bond?
Brady bonds. Anybody want to comment on the
Yeah,
Brady bond?
just a small comment. Actually, Europe was very involved in the Brady bond plan, so they are very well aware of that. Again, what was the solution there? The creditors agreed to take a hit, right? That's very important. And the creditors were separate from the debtors, right? I mean, okay, again, it was solved because you had an external number of creditors which agreed to, one, to take a hit, and two, were not related to the debtors. That's why my proposal solution is, you want to solve the European problems, you need to go out of Europe.
Anybody else? Yes, sir.
My name is Andreas Kern. I'm from Georgetown University. I agree with Jacob that the ECB easily has €2 trillion actually, because as long as they've got paper and ink, they might print this money. However, I believe it politically makes a huge difference whether these 2 trillions are used to recapitalize European banks rather than directly bailing out basically countries. Don't you think that Europe is playing, or like European policymakers within the European Council are just playing on time to force the ECB to bail out once again the banking system in Europe in order to end basically the crisis, which would be politically less costly, would not violate so many European basically treaties and so forth, and basically would resolve the problem in the short run. Secondly, given the external position of the Eurozone countries, which is positive right now, I don't believe that basically international investors would flee the Eurozone, because what would happen if, for instance, Germany calls in all its outstanding debt to the United States of America and also its foreign direct investment positions, for instance, in China, to mobilize its funds? Because then we would, at the very end of the day, learn that basically international financial markets make us all very vulnerable to these short-run decision-making processes. And my question is whether it makes a difference whether I bail out countries directly or whether I just basically take the bazooka and give it into the hands of someone else, of people like Joseph Ackerman and so on and so forth. Thank you.
Boy, that really makes us feel good. Yeah, yeah. Go ahead, Desmond.
Just let me clarify something, is that the IMF has made estimates that the amount of money that you need to recapitalize the European banks is around about 200 billion euro. You know, that some people think a bit less, some people might think a bit more, but you're in that ballpark. The 2 trillion euro is in order to prevent people from selling off the bonds in Spain and Italy. That Italy alone has something like 1.9 trillion euros of bonds as a stock. And what they're having to do is they're having to roll over something like 250 billion a year. So you're wanting to have a big firewall, so when the Greek default occurs and it begins hitting Portugal, Ireland, when it comes to Spain and Italy, you know that there's money there, more of liquidity provision rather than transferring it. So I don't think that you're wanting to confuse the 2 trillion euro being used to bail out the banks. You just need something like 200 billion euro, and the idea there is that that 200 billion would either come from the banks themselves placing securities in the market to recapitalize themselves. Of course, the banks don't want to do it because it would dilute their equity a lot, or you get the national governments to come in and bail them out. And as a last resort, you might turn to the EFSF, but you're only talking about 200 billion, which is different from the 2 trillion.
No, I just referred to the number which was said earlier. That was the idea.
Right, but the 2 trillion is for a firewall. It's not for recapitalizing the banks.
There was a hand at the back there. I'm just keen to make sure we don't.
Hello, Robert Kent from University of Glasgow. So we hear stories about in Greece of people protesting about, having to work for a couple extra years till they're 65 and no one pays income tax and things like that. And it sort of gets to the productivity question that we were talking about. And so if there is eventual fiscal union, can that address the productivity problem, which seems to be a long-term underlying issue beneath all of this?
Yeah. You want to take that?
Well, I mean, there's no doubt that the fiscal union itself can obviously not. Because the competitiveness, productivity, even imbalances question is a long-term one, and the fiscal union cannot do it. But on the other hand, various conditionality for receiving such fiscal transfers might be able to do it. I mean, this is essentially, that's what the IMF program is there for. And I think if you look at the actual IMF program and you assume that it is in the end, reluctantly, and over the dead bodies of a couple of Greek governments being totally implemented, I mean, it will have an effect. I don't think that anybody can look at that and say that's not the case, but it won't be the fiscal union that does it. It will be the implied conditionality in it.
The gentleman here. Yes.
My name is Tom Caruso. I'm with Morgan Stanley. And if we have to look for
It's
someone
okay.
outside of the European Union, and obviously it's not going to be the United States, I know you brought up China. China can be the bazooka, and there is a phenomenal amount of business being done between China and Europe. Could you mention that? And the other is, on the longer term plan, what other countries would want to be in the euro? What countries would you be looking to bring in the euro to make the European Union stronger?
Okay, two questions. Yeah. Jacob and then Liliana.
I can answer the China part.
All right, so Jacob
I'll
first.
take the first one. I mean, if you look at the political commitment by current European leaders, pretty much everybody except the UK and the Czech Republic has signed up for the Euro Plus Pact. So I think you can safely expect that in the longer term, everybody, with the exception of the UK, is going to join the euro area. Because as the euro area institutionalized deeper, the political costs of the small open economies that are currently, in the EU but not in the euro area is going to rise exponentially. The only country that has the political and economic size to remain outside is the UK.
And
yeah, on the China thing, no, I really think that this is mostly an issue of developed countries. I think that China have some resources, but it's not politically feasible to expect that China is going to be provided with those resources. And related to that, what do the Eurozone need is really just euros? Well, you need to remember something. Just recently, can't remember when exactly, but there was this facility to provide liquidity in dollars until the end of the year. Because at the end of the day, what the world turns to need when there is a huge liquidity squeeze is US dollars.
the gentleman at the back, and then I'm coming to you. Yes.
Yes, thank you. Rob Collarina, AIAC Investment. Sort of following up on Liliana's comment earlier about creditors and debtors, are you all seeing reception towards a mezzanine debt instrument or conversion in some of these restructurings for debt for equity swaps?
That's of a second order solution. Yes, there are room for all kinds of instruments that would alleviate that. But the truth of the matter is, it doesn't matter how you construct it. The bottom line is that you have to have a haircut. Could it be through those kinds of instruments, through changing interest rates, through increasing maturity, through, name it, it doesn't matter. The availability of resources that debtors have to increase, and the amount of transfer from the creditor has to be there, not for the short term, but on a permanent basis.
What about counterparty guarantees, though?
Again, the guarantee is as good as the issuer, right? I mean, the word guarantee always drives me crazy, because a guarantee, you first look, when somebody receives, if I'm a creditor, I'm extending a loan. The first thing that I look is at the quality of the debtor, number one. Second, I look at the guarantee, right? If the guarantee is related to the debtor, the guarantee really is worth very little to me. So.
Gentleman here at the front.
Yeah, sure. Josh Townsend with Philip Morris International. Just picking up on what Liliana was saying about this now having moved and evolved into a banking crisis and political fixes that the ECB can do. In light of Dexia over the past couple of weeks and the misjudgment, ultimate failure of them to judge the liquidity, the capitalization of Dexia, Is it possible, are we going to see in the future the ECB trying again to do another round of stress tests? And have they already lost their credibility now on the world stage in order to try and shore up more confidence in that way? Thank you.
The ECB, I don't think the ECB has lost its credibility at all. By the way, my suggestions is because I want to preserve the credibility of the ECB. To me, the ECB will lose its credibility if it expands too large. I mean, it's so much that markets are going to price that in and say, well, no, really, I mean, what you are issuing is a very devalued currency in real terms, and therefore you don't have that credibility. I think that on a case-by-case basis, there is a lot of room for ECB intervention, for providing liquidity when it's needed, from even buying, expanding more its balance sheet with purchase of certain kind of assets, like in the Dexia situation. But what I want is to preserve the overall credibility of the ECB, which I don't think is wrong.
They have already committed to unlimited liquidity for 12 months, including expanding the covered bond program, which is essentially a way for banks to raise capital. Going beyond that, it's clearly in the hands of governments.
Okay, I want to make a comment, ask a question of the panel. So the US Congress, under no circumstances, will even consider the possibility of supporting a European bailout in the event of the crisis spreading to Italy and Spain. And anyway, Europe is rich and can afford to pay for it. Two problems with this thesis, and then my question. The first problem is, if Europe is so rich, then why isn't it solving the crisis already? I mean, in other words, what I'm saying is, maybe Europe is not as rich as people think, or maybe the politics is such that Europeans like to project themselves as a unified bloc when, whatever the discussion requires. But then in practice, they don't act that way. They are a bunch of still sovereign nations going in different directions, which is one of the reasons that the ECB politically cannot do what the Federal Reserve can do, as Liliana said. So that's one observation. And then the second observation is, so Italy cannot repay its debt. Spain cannot, refinance its debt. So now we're talking about economies that are, in the trillions of euros. And it is highly likely, on current trends and evidence, that the Germans are going to find it very, very difficult to pay all that money, for all the reasons we have discussed. And then what's the United States going to do? So the United States is going to just stand back and just let these countries go under? Do we realize that the debt of Spain and Italy is a much, much bigger problem than the subprime problem ever was? Is this going to be a global banking crisis of Lehman-type proportions, or even bigger, perhaps, because there's no backup, and because it affects the European banks that are much more important than the American banks by the structure of the system? Are we really going to allow this to happen? Or are we going to go back, as we did in the TOP program a couple of times, to the Congress, until the Congress said, hey, all right, we can do this. So my question to the panel is it serious? Are we really, if it came to that, are we really going to let Italy and Spain go? Desmond.
Yeah, I think that there's just a minor issue like a 2012 presidential and congressional election that gets in the way, that is and going to get in the way of the United States going and riding into the rescue of Italy and Spain. I think I agree with the premise of your question, which is basically the United States is hugely exposed to a Lehman-style event in Europe, that our banks have got $1 trillion of exposure there. Our money market funds had, till recently, over $1 trillion invested in European banks. We've written a whole bunch of derivative contracts. So if Europe really does fail, that is not going to be a European event. That's going to be a global event. That's really going to impact the United States. But you'd think that this would be in the United States' interest. But I think in the same way as Europe is tied up in political knots, the United States will be the same, and this will play out. There's no way that the United States Congress, that has got real budget problems of its own to deal with, is then going to have an appropriation for some countries in Europe who've been lecturing us on the waywardness of our ways, how their model is better than ours. That there's a lot of feeling in the United States. Europe's had it coming to them for a long time. Let them stew. That people aren't going to really see that we're in the same boat. So, I think politically it'll play out that the United States will do very little to lift a finger. And that's what Geithner is doing right now. Geithner knows that there's no appetite for providing money from the United States. So what he can do is he can offer them the benefit of his experience with the housing market resolving the United States banking crisis, which the Europeans, you can imagine how graciously they're receiving him and telling him what to do with his advice.
Antonio, do you want to comment?
Yes, let me go for your first question. Whether we are a union or we are a conglomerate of countries. And we are both. The uniqueness of the European model is that we have common policies, common institutions, but at the same time we are 27 sovereign states. And it has proved to be extremely successful in many respects, but we will not hide that in some others there was the need for a review of the mix of European and national sovereignty. And this is what has been happening. It has been happening since 1 year and a half. It's already happening this week in the run-up to the European Council this Sunday. So indeed, coming back to the initial premise, there was an institutional incompleteness, and this is what's being fixed now, so that we will be able to get the benefits and still go farther. What will come out of it will need not be the same as this country. It will be an integration that need not resemble the fiscal federalism in this country, but it will be more integrated. And in this respect, we will be able to reconcile once more 27 nations, 27 sovereign states, with institutions that we have created to cope with the common problems.
Well, on the first question, the problem is that you've got 85% of the European populations that primarily identify as citizens of their own nation state. They're Belgians, they're Germans, they're French, they're Spanish, they're Greek, and whatever. What that means is that if you cannot legitimately shift towards a transfer union, it simply will not politically fly. And you don't have the option that, and therefore you don't have the option that, the United States adopted after the War of Independence to deal with its contagion issue in the sovereign debt market, which was, of course, to consolidate, Hamilton's great idea, to consolidate it all into one federal debt. That option, for political reasons, does not exist in Europe. So in that sense, you're somewhere in between. But I think, having said that, it's quite clear that the crisis, as Antonio said, pushes you in the direction of allowing more and more fiscal federalism. on the second point about whether or not policymakers in Europe or the US Congress would allow the global economy to go to hell in a handbasket, no, they won't. Because, I mean, but I don't think that it'll actually get to the point of asking the US Congress in several sort of TARP 2 votes. It'll be the ECB that cracks in this regard. I mean, if we're thinking about Spain and Italy failing, what does that mean? It means that they won't be able to place debt in the primary markets. Well, there are ways around that. You know, you could have them being bought by national domestic banks in these countries, and then under emergency liquidity assistance, actually repo them with domestic central banks. I mean, the point being that there are ways in which you can deal with this, and in my opinion, will deal with this in an emergency. You cannot, for political reasons, say out loud that this is what you're going to do, because it would be, as I said earlier, in breach of Article 123 of the European Treaty. But you do have the ultimate backstop, and that is why the security markets program is going to remain dormant as part of the tools that you have in the cupboard that you can draw out in the crisis.
Liliana.
Yes, you started your comment, Yuri, saying that Europe is rich. Why doesn't it deal with its own crisis? Argentina was also very rich, still is very rich. Very rich country. Wealth is not what determines a crisis resolution. It's liquidity that hits you. The need to roll over maturing existing debt is what kills you. People always think, oh, I just have a liquidity problem, I don't have a solvency problem. I'm sorry, but the land of Argentina could not be sold in a second. And neither are the airports in Spain, by the way, with the privatization program that they have started. So you can have a lot of wealth, but it's not tradable right now when you need the resources. So that's why I think that that's not the issue. You can be very, very wealthy and still fall into collapse. On the US reaction, well, I have very bad news from my perspective. I think that the US crisis would not have developed to the extent whether if politicians would have reacted much faster. I mean, many economists knew what was forming in the subprime market. But politicians let it go and grow until it collapsed, and then reacted, right? Okay, with the status right now and the elections coming in the US and whatever, I think that the US could let the world sunk. Of course, they will react later on. But I think yes. I think that there is a possible scenario where we will have a huge economic crunch worldwide with much more deleveraging and with a much higher credit squeeze than the one we are facing now.
Thank you very much. Just by way of a very quick synthesis, it is remarkable, given the brilliance of our panel, that they should disagree so much after so much reflection. They do agree, our brilliant panel does agree, and everybody agrees, that the euro is under-institutionalized.
That's right.
That's true.
You must watch and go back to the Peterson Institute anytime you see an under-institutionalized person walking around. So that's number one. They do agree, we need those reforms in the link. Beyond that, these guys think 100% probability the euro will survive.
At least.
At least. These guys on my right think that there is a very low probability that the euro will survive in the short term. There is also a deep division of views about if the crisis gets worse, and there is a fair probability that the crisis gets worse, according to our panel, I think with perhaps one exception. If the crisis gets worse, there's a deep division between, on the one hand, people who say, on my left, that Europe will be able to handle it on its own, and people on my right who, on the other hand, say either they can't handle it at all, the thing will collapse, or that they can only handle it if they get external help, okay? That's my synthesis, and that's why I think we're going to have another Euro event in a few months' time. And
title.
I hope the title doesn't get much worse than this one. Thank you very much.